Hello friends. Friends, we will continue with our discussion on retirement of partner. So, we have covered all the aspects that were common with the previous chapters, like chapter 3, change in profit sharing ratio, and chapter 4, that is admission of a partner. In this lecture, we'll be starting with a new topic, right? So what we have discussed is, we discussed about new profit sharing ratio, right? In this we discussed about gaining ratio also. Clear? Then we discussed about goodwill. In goodwill, we discussed that we have to give to the retiring partner his share in goodwill because he was a part of the partnership firm during which the partnership firm gained a good reputation in the market, right? So he deserves a part from goodwill also. Okay. Then we discussed about revaluation, right? Revaluation of assets and liabilities. Clear? Here also we say that on the date of retirement, we will revalue the assets and liabilities, and any profit or loss on revaluation that will be distributed among the old partners in old ratio. That means the retiring partner will also get the share in the profit or loss on revaluation of assets and liabilities. Clear? Then we discussed about reserves and accumulated profits and losses. Clear? There also we say that any reserves, any accumulated profits or losses that are appearing in the balance sheet, right, they should be distributed among old partners in old ratio. Now, we are going to discuss a new topic, that is payments to the retiring partner. Payments to the retiring partner. Now, what do you mean by this? See, like I told you that we have to make various payments in case of retirement. We have to pay the share of goodwill also to the retiring partner. The retiring partner will also get the share in the revaluation of assets and liabilities. Any profit or loss on the revaluation of assets and liabilities, that is to be distributed among the old partners in old ratio. That means the retiring partner will also get a share in the profit or loss on revaluation of assets and liabilities. Third, if we talk of reserves and accumulated profits, again, any reserves or accumulated profits appearing in the balance sheet that are to be distributed among the old partners in old ratio. Old partner means the retiring partner will also get a share in the reserves and accumulated profits. Right? So, we have to make the various payments to the retiring partner. Clear? Now, how to make these payments? What we will do is, we will prepare partners' capital accounts, right? We will prepare partners' capital accounts, all partners' capital accounts, okay? Then we will do all the adjustments. All adjustment means adjustments regarding goodwill, revaluation, reserves, We will do all the adjustments in the partner's capital account, right? Now, we will get closing balance of the retiring partner's capital account. Clear? What this means, closing balance of retiring partner, this closing balance means the amount that is payable to the retiring partner. Why we are preparing is, we have to identify the amount that is payable to the retiring partner. So after all the adjustments, whatever the closing balance in the partner's capital account we will get, that balance will reflect the amount that is payable to the retiring partner. Is that clear? Then we will transfer this amount to the retiring partners. We will transfer this amount to the retiring partner's loan account. Clear? Why loan account? We will consider this that we took a loan from the retiring partner and we have to repay this loan. That's why whatever the amount will be payable to the retiring partner, we will transfer that from the capital account to the partner's loan account. The journal entry for this will be retiring partner's capital account debit, right, to retiring partner's loan account, right? The new partners who will continue the business will pass this journal entry, right, in their books, and they will transfer the amount that is payable to the partner, to the retiring partner. They will transfer that amount to his loan account, because that is a liability for the business, liability for the continuing partners to pay to the retiring partner, and they will show it as a loan that is repayable to the retiring partner. Is that clear, friends? So, what are the steps to be considered while making the payment to the retiring partner, while calculating the amount that is payable to the retiring partner? First of all, we will prepare the partner's capital accounts. Then we will make all the adjustments regarding goodwill, revaluation, reserves, everything. Then we will find out the closing balance of the retiring partner's capital account. That closing balance reflects the amount that is payable to the retiring partner. And the continuing partners will pass a journal entry in their books. They will transfer this amount payable to the retiring partner to his loan account. They will show it as a loan, as a liability of the firm, that they are liable to pay to the retiring partner. They have to pay this much amount to the retiring partner. Clear, friends? So now, if we say that the new partners consider this as loan, we are saying that they transfer the amount to the retiring partner's loan account. What they are considering is that they have taken a loan from the retiring partner, right? And they are liable to repay that loan. Isn't it? So, one more liability with this arises. What is the liability? With this, another liability arises, that is payment of interest on retiring partners loan amount. Sir, if they are considering, if the new partners, the continuing partners are considering that it is a loan to the business, right? They say that we are not in a position to pay you right now. What we are doing is we will transfer the amount that is payable to you. We will consider this amount as loan to the business. We are not in a position today to pay you the whole amount. So we will consider this as loan and we will repay in installments, right? So in that case, they are liable to pay the interest on this amount that they have considered as loan from the retiring partner. What is the rate of interest? Normally, the rate of interest will be 6% unless otherwise agreed, right? If there is no agreement, then the continuing partners are liable to pay interest at the rate of 6% on the retiring partner's loan amount, that is the amount that is payable to the retiring partner. On that amount, the continuing partners are liable to pay interest at the rate of 6% unless otherwise agreed. If they agreed to some other rate, then the continuing partners will pay interest on that rate. Clear, friends? So let's do one practical problem on this, right? Let's do a practical problem on this. Read. A, B and C are partners in a business sharing profits and losses in the ratio of 3:2:1, right? Their balance sheet as at 31st March 2016 was as follows. We have on the liability side, we have sundry creditors, general reserve, capital accounts, and on asset side, we have cash in hand, cash at bank, sundry debtors, stock in hand, machinery and factory building. Further, it says that C retires from business on 1st April 2016. It was agreed that the amount due to him will be treated as loan. It is very much clearly mentioned in the question that you have to treat it as loan. It was also agreed to adjust the value of assets as follows. Okay. How to adjust the value of assets? They say provide a reserve of 5% on sundry debtors for doubtful debts. Create provision for doubtful debts at the rate of 5%. Depreciate stock by 5% and machinery by 10%. Factory building to be revalued at 15,100. Goodwill of the firm is valued at 15,000 and A and B will continue to carry on business and shall share the profits and losses equally in future. Prepare profit and loss adjustment account, that is revaluation account, partners capital accounts and the balance sheet of this firm as at 1st April 2016, that is on the date of retirement. Clear, friends? So what we have is we are given the information that we are revaluing our assets and liabilities. So the first step is we have to prepare the revaluation account. Clear? So let's write down the facts. What are the facts? Let's see. There are three partners, A, B and C, right? They are sharing profits in the ratio of 3:2:1. Now this C is retiring. C retires. They will continue to share profits equally. Right? That is their new profit sharing ratio, 1:1. Okay. And the question clearly says that whatever is payable to the C, that will be treated as his loan. So we have to find out that the amount that is payable to the retiring partner, that is C. For that, according to the information, we will go step by step. First of all, we will prepare revaluation account. We will prepare revaluation account. I really hope that every one of you can prepare this, right? So I will suggest, friends, first do it on your own and then you can go through, okay? Try doing the questions on your own. If you know the concept, you can easily do it. I guarantee you this. Please prepare proper formats in the exams. Okay. So we have debit, credit, amount, particulars. What is most important is that you should be clear with the concept, what the concept is saying and what it requires you to do. Okay. So, if you see the question, what are the various adjustments that are to be done in the revaluation account? See, the first point reads, provide a reserve of 5% on sundry debtors for doubtful debts. What are the sundry debtors? 9,000. Then, what will be the provision? 5% of 9,000, that is 450. So, we'll say to provision for doubtful debts. Remember the journal entry. By creating a provision for doubtful debts, you are reducing the value of an asset. And if you are reducing the value of an asset, we will credit that asset and we will debit the revaluation account. The journal entry will be revaluation account debit to provision for doubtful debts. That's why we will write here the provision for doubtful debts as 450. Okay. Next, he says depreciate stock by 5%. Reduce the value of stock by 5%. What will be 5%? We have a stock of 7,000. 5% of 7,000, 350. Again, we are decreasing the value of our asset. So we will write as to stock 350. Clear? Next, they say depreciate machinery by 10%. Machinery is 6,000, 10% is 600. Simple. If you can create a journal entry, if you are clear with the rules of journal entry, that if we are reducing the value of an asset, we have to credit that asset and we will debit the revaluation account. This comes to 600. Clear? Next is, he says factory building to be revalued at 15,100. What is the current value of factory building? 14,000. So that means there is an appreciation in the factory building value by 1,100. Clear? So we will write by building, or you can write by factory building 1,100. Now what is the total of this side? 450 plus 350 comes to 800. 800 plus 600, 1,400. That means we have reduced the value of our assets by 1,400, but there is a gain on the revaluation by 1,100 only. We have reduced by 1,400 and we have increased by 1,100 only. That means we have a loss on revaluation of 300 by loss on revaluation 300. Now this loss is to be distributed. This loss is to be distributed among whom? Old partners in old ratio. What is the old ratio? Old ratio is 3:2:1. So in this ratio, this loss on revaluation of 300 will be distributed. This will come to 150, 100 and 50. Clear? So this is a revaluation account. We have a loss on revaluation. This loss on revaluation will be distributed among all the partners, including the retiring partner, in old ratio. What is the old ratio? 3:2:1. Clear, friends? So one thing is over. Nothing regarding revaluation. Now the fourth point says the goodwill of the firm is valued at 15,000. Now the retiring partner also deserves a part of this goodwill. Now let's talk about goodwill. He says goodwill of firm is 15,000. Clear? What is C's share in goodwill? What is the C's share in goodwill that is payable to him? 15,000 multiplied by his share in the profits. Right? This comes to rupees 2,500. Clear, friends? So the total goodwill of the firm is 15,000. Out of that, we have to pay some share to the retiring partner. What will be the share? His share in profits. So we have to pay 2,500 to C. Who will pay this 2,500 now? This 2,500, who will pay? The continuing partners. Who are the continuing partners? A and B. In which ratio they will pay? Please go through the topic of goodwill. Right? Who will pay this? A and B will pay this rupees 2,500 to C in which ratio? In gaining ratio. Now sir, how to calculate gaining ratio? Again, go through the goodwill, go through the initial lectures. What is gaining ratio? Gaining ratio is new share of the partner minus old share. Clear? Now, if we talk of A, what is the new share? 1/2. What is the old share? 3/6. This comes to 0. That means A is gaining nothing on the retirement of C. Talk about B. 1/2 minus 2/6. This comes to 1/6. That means on the retirement of C, A has gained nothing and B has gained 1/6 share. Now, the question is, who will pay this 2,500 to C? I said A and B will pay because they are the continuing partners. But will A pay? Now the question is, will A pay something to C? Think about it. A has not gained anything from C on his retirement. A will say, why should I pay? B is gaining, B is liable to pay everything. So, here I will say, B will pay goodwill amount of rupees 2,500 to C. Clear? Why only B is paying? Because A has gained nothing on the retirement of C. Only B has gained, therefore B will pay. Clear, friends? Let's see the question. What is the last part? A and B will continue to carry on business and shall share the profits and losses equally in future, that we have discussed. One point I told you, there is a case of goodwill in which the payment is to be made to the retiring partner. Then we have revaluation that we have covered in this question. Then we have reserves. See if there are any reserves appearing in the balance sheet on the date of retirement. Yes, sir. There is a general reserve of 6,000 appearing in the balance sheet. There is a general reserve of 6,000 appearing in the balance sheet. So the third part is reserves. Clear? So there is a general reserve of 6,000. Now what to do with this general reserve? All the reserves appearing in the balance sheet on the date of retirement, they belong to old partners in old ratio. Clear, friends? So what will be the journal entry? Journal entry will be journal reserve account debit. Why? Because these are nothing but the part of profits only. So anything that is earned before the change in partnership, before admission, before retirement, anything that is earned that belongs to old partners in old ratio. Always remember this in case of admission also, in case of retirement also. Anything that is earned before the change in the constitution of partnership, that belongs to old partners in old ratio. So the journal entry will be to A's capital account, to B's capital account, and to C's capital account. What is the amount? 6,000. What is the ratio? 3:2:1. It's very simple. 3,000, 2,000 and 1,000. Clear? Anything else left? We have covered goodwill, we have covered revaluation of assets and liabilities, and we have covered reserves and accumulated profits and losses. So now we are ready for adjustments in the partner's capital account. Like I told you, we will be preparing the partner's capital account and we will do all the adjustments. We have done the working on the adjustments and now we are ready to prepare partner's capital accounts. Now, let's see. Now we will prepare partners capital accounts. Clear? Okay. Please, friends, prepare proper formats in the examination. Okay. So we have three partners, A, B, and C. Okay. Debit, credit, particulars A, B, C. Particulars A, B, and C. So first of all, we will write the opening balance in the partner's capital accounts by balance brought down. That balance we will get from the balance sheet, 10,000 each, right? So we'll say 10,000, 10,000 and 10,000. Clear? Now, let's see what we did in the first. The first thing we did is revaluation. Distribute the profit or loss on revaluation. There was a loss on revaluation that has been distributed among the partners. Okay? So, we will distribute this loss on revaluation among the partners. We will say to revaluation account, this comes to 150, 100 and 50. Clear? Second point was goodwill. So the goodwill amount that is payable to C was 2,500, and when we calculated the gaining ratio, we see that A has gained nothing. That means only B has gained, and B will pay the whole amount of goodwill to C. So what we are going to write is by B's capital, okay, 2,500, because we will debit the account of B. B is paying to C, okay. So to C's capital. How much? 2,500. Next, third point was reserves. We discussed that any reserves appearing in the balance sheet on the date of retirement that belongs to old partners in old ratio, and we pass the journal entry, so easily we can say by reserves. How much? 3,000, 2,000 and 1,000. Clear? So now friends, what we are going to do is, what you should do is, first of all, calculate the balance of the continuing partners. Very simple, right? Because we have nothing to do with those balances as such. So this balance comes to 12,850. This balance comes to 9,400. First of all, complete the account of continuing partners. Okay? Then we will see the retiring partner. So this comes to 13,000 and this comes to 12,000. Okay? This comes to 13,000 and 12,000. Clear? First of all, close the accounts of the continuing partners. Now, let's see what is payable to C. What is payable to C? 10,000 plus 1,000 plus 2,500. This comes to 13,500 minus loss 50. Clear? This amount is payable and this is receivable because there is a loss on revaluation. So what is the amount payable to the retiring partner that we will transfer to the loan account? This amount comes to 13,450. So this amount is 13,500. 13,500. In this way, we will close the account of the retiring partner by transferring the amount that is payable to his loan account. Clear, friends? So what we have done is we have identified the amount that is payable to the retiring partner, and that amount we have transferred to his loan account because it is clearly mentioned in the question that you have to consider this amount as his loan. Right? Fine. Now, this is the partner's capital accounts. Now we will prepare balance sheet, because this is what is the requirement of the question. Okay. You can easily prepare the balance sheet now. I will suggest that you should first try it on yourself. You can pause the video and try on yourself preparing the balance sheet. If you are clear with the concepts, then you can prepare the balance sheet. Liabilities, amount, assets and amount. Now, let's go one by one. First, see the liability side. Sundry creditors, 1,600. Anything done to that? No, as such. Creditors, 1,600. Reserves. So, this we have distributed among old partners in old ratio. So, it is finished. Anything new added to the liability side besides the capital? Yes, sir. There is a loan account. C is loan account because that is a liability for the business, and we will show it on the liability side. C is loan account. This amount comes to 13,450. Anything else, sir? Capital accounts of the continuing partners. A. B. A's balance is 12,850 and B's balance is 9,400. This total comes to 22,000 250. This is all about the liability side. We have the creditors as such of 1600, general reserve we have distributed, seize loan is the new liability on the retirement, and we have the capital accounts of the continuing partners. Let's see the asset side. Cash in hand, cash at bank. Anything done to it? No, sir. This will appear as such at 600 and 1000. Okay, sir. I'll say cash in hand 600 and cash at bank 1000. Clear, friends? Next, sundry debtors. Yes, sir. What about sundry debtors? We have created a provision on sundry debtors of 5%, that is 450. So I can say debtors 9000 minus provision. How much? 5%, that comes to 450. So this comes to 8550. Next point. Stock in hand 7000. We have depreciated stock in hand by 5%. That is 3500. So what is the stock in hand left? This comes to 6650. Clear? Next we have machinery. We have depreciated the machinery by 10%. 6000. 10% of 6000 is 600. So what is the value of machinery left? 5400. Clear? Now, what else? We have one more thing, that is factory building, and we are given that it is revalued at 15,100. So we have a building of 15,100. Now this is all about your balance sheet, and if you tally it, you will get a total of 37,300. 37,300. So this is the balance sheet of the new firm, that is after the retirement. This balance sheet is after retirement. This balance sheet is as at 1st April 16, that is on the date of retirement of the new partner. Clear, friends? So I really hope that you are clear with the concepts, that what we have to do in case we have to identify the amount that is payable to the retiring partner. We have to prepare partner's capital accounts, and for that we will first do all the adjustments. Right? Prepare partner's capital accounts. We have to do all the adjustments relating to goodwill revaluation and reserves. Clear? Then we have to identify, first of all, close the balances, find out the closing balances of the continuing partners. Right? Then find out the balance of the retiring partner. That balance will be transferred to his loan account. That balance is transferred to his loan account. Okay. For that, the journal entry is retiring partners capital accounts to retiring partners loan account. Then the continuing partners are liable to pay interest at the rate of 6% on this loan amount. Clear? So we have done it with a practical problem now. So this is the balance sheet as on the date of retirement. I hope this is very clear, friends. Now, in the next lecture, what we are going to discuss is the various modes of payment. In the next lecture, we are going to discuss about the various modes of payment. Which payment? The payment of amount that is due to the retiring partner. The modes of payment to retiring partner. Okay. So we will discuss this topic. We'll do some practical problems on this topic. Right. First of all, you should learn then how to calculate the amount that is payable to the retiring partner and how to treat that amount. We have to transfer that amount to his loan account, right? And now in the next step, in the next lecture, we will discuss how this amount that we have identified in this lecture, how we are going to pay that. Clear, friends? So that's it for this lecture, friends. Thank you so much.